Forex market that's different than the other markets that are going to be the reason why some of the candlestick signals are constructed a little differently, as we'll look at later. The lines above and below the real body are called the shadows. So we have the upper shadow and the lower shadow. The high of the upper shadow is the top of the session, and the bottom of the lower shadow is the low of the session. Now, I had mentioned some of the benefits you'll be walking away with at the end of the seminar. The early reversal signals, avoiding bad trades. You'll also be able to, and let me explain why, be able to combine candlesticks with your favorite Western charting techniques. Remember, one of the things we'll be talking about today when we did the overview was candles and Western technicals. You know, I'm asked, Steve, if candles are so great, why Western technicals? Well, let me ask you this. What 4 data points do we need to make the candlestick line? Open, high, low, and close. What do we need to make a bar chart? Same thing. And this is really valuable, and this is why I'm able to do seminars for institutions. Whatever Western charting techniques you use, Fibonacci retracements, and I'll show these later on, moving averages, Bollinger Bands, trend lines. Obviously, we don't get volume in the Forex market, but for those who trade non-Forex, volume. Whatever you do in a bar chart, you do in a candlestick chart. But by adding the visual insights of the candles, which we'll be looking at later, if you get a candlestick signal confirming a Western signal, the probability of a trade working is much, much higher. And as I just said before, the reason I'm able to do seminars for institutional traders, I don't go in there saying, hey, use the candles instead of what you've been using over the last 10 years for your career. What I suggest is use this in addition to. And that's what I suggest to you. You may have your own favorite Western charting techniques. You may find a moving average works particularly well, an oscillator. Stay with it. Don't give it up. Add the candlesticks to it. This is a very, very powerful aspect of the candles. The lines to your right are called doji. And doji are sessions where the open and closing are the same. And doji, again because of the Forex, are going to be viewed a little bit differently than non-Forex. So before we move on, are there any questions about the construction of the candlestick line? Yes?
I have a question about the use of candlesticks on different platforms, because I've noticed that, like, if you have one data feed based on one bank, then you have, it's very clear that the close of one candle is equal to the open of another candle.
What I would suggest doing, and we're going to look at this in a couple of minutes, is don't be too critical about if one candlestick line is a doji and another one on another platform has it not quite a doji. And we'll look at that in a couple of minutes. Right? But essentially, I think it's really important if you're using a data source, most data sources close at 5 o'clock. I would really make sure it does that. Because most of the people who trade, the institutions, will have it closing at 5 o'clock in New York. Now, how can we use the candlestick lines? We're going to start looking at single candlestick lines. The Japanese will say the real body is the essence of the price movement. And that's a really exciting concept, because what the candlestick line shows is the force behind the move. If we have a long white real body, who's in charge? The bulls, right. A long black real body, obviously the bears are in charge. Now, as the real body gets smaller and smaller, we wind up with what the Japanese call spinning tops. These are just small real bodies. And what's wonderful about the candlesticks is that they alert you to subtle changes in the markets, the supply-demand situation. So with the tall white candle, the bulls are in charge. The long black real body, the bears are in charge. As we get these diminutive real bodies, as shown here, it shows the market may be losing a little bit of force. Now, let me show you why, if you're trading with a bar chart, and it's to your credit that none of you are, But if you're trading with a bar chart, you're trading at a real disadvantage. Okay, here we have a chart, a bar chart, and based on this bar chart, the market looks fairly healthy. It's holding the highs very well. No reason for caution. Now we take the same data as this bar chart and convert it into a candlestick chart. Remember, we use open, high, low, and close. See the different visual representation we're getting? Although the market's holding the highs very well, is it doing so with long white wheel bodies or with spinning tops and doji? Obviously the latter, correct? And what this is showing us is that the market may be losing some steam. And this is what unfolded after. Okay, obviously it's not going to work that well every time, but what's really important about the candlesticks is that although it uses the same data as the bar chart, it shows us the price. The candles show us the price, correct? Like a bar chart does. But the power, the potency of the candlesticks is that they also show us the force behind the move. That's the difference between a bar chart and a candlestick chart. I guess you could mentally convert a bar chart into a candlestick chart, but why bother, right? It's done on the charts for us now. Years ago, when I was doing research into the candles in the 80s, no charting systems had candlestick charts. I had to draw them all by hand. Okay, now all the charting packages have candlesticks. So this is what we're going to be looking at today, reading how to gauge what the candles tell us about the momentum of the market. So, although the market's descending here in this blue circle, what's happening with the bearish control of the market? Gauged by the real bodies. What's happening with those real bodies in the blue circle? Getting smaller and smaller, exactly. Now, I don't know, I might be buying here because the market seems to be stabilizing. Normally, if we have, let me go back here, I would not be selling short here. As we progress in the seminar, we'll be talking about using candlesticks to initiate a new position as opposed to using candlesticks to offset a position. But based on this slide, I would not be shorting here. It's rare for me to recommend going counter-trend with a new trade based on a single candlestick line. Something like this I would use to lighten up on long positions. Move up stops. Take some profits. Now, getting to this slide, it's not so much the real bodies that are making me less bearish. I might actually think about buying here because just as you would on the bar chart, what's going on? What's happening to the lows? Right. You see, we're going from lower lows to the same lows, and then we're making higher lows. So the market's making a rounding bottom. And what's nice about this, although there are no specific candlestick signals, is we have a very clean-cut stop-out level. We'll talk about trading psychology a little bit later. There's not really a course in trading psychology, but my feeling is whenever you're going to place a trade, set a stop before you place the trade. That's when you're most objective. So it's the same information as the bar chart, but because it's drawn a little differently, we get volumes of more information, volumes and volumes of information that you just don't get with a bar chart. And sometimes a little difference, and that's all this is. It's the same data, but it's drawn differently. Sometimes a little difference makes a big change. So with that in mind, I have this slide. Okay, a different perspective changes the whole picture, and you're going to have to watch this as I progress. Okay. I'll go back. Some of us, it looks like a face, right? And now it doesn't look like a face. Different perspective.